When I came into the market as a young man, I came in with conviction. I didn't tiptoe. I didn't ask permission. I saw something on the tape, and I acted. That's how most traders begin, full of certainty and short on patience. They feel the market is finally speaking to them. But let me ask you something. Have you ever noticed how easy it is to enter a trade, and how hard it is to define where you're wrong? I learned early that conviction is cheap. Anyone can feel sure when the market is moving in the direction they want. A rising stock makes believers out of doubters. A falling market convinces pessimists they were prophets all along. But the market doesn't pay for conviction. It pays for discipline. And discipline begins not at entry, but at the point where you admit failure. Have you ever entered a trade knowing exactly why you were in, but not knowing where you would get out if it went against you? Most traders don't avoid defining failure because they are foolish. They avoid it because it's uncomfortable. It feels like doubt. It feels like weakness. They think that by drawing a line where they will admit they are wrong, they are somehow weakening their position. But the truth is the opposite. Strength in speculation comes from knowing your risk before you count your reward. Isn't it strange how traders will calculate profits down to the dollar, but leave losses to chance? I have always said that the big money is not in the buying or the selling, but in the waiting. Yet waiting requires something most traders lack, a clear understanding of when they are no longer right. Charts don't lie, but traders often refuse to listen. A stock breaks a key level. Volume changes character. The market stops acting the way it should. That is the market speaking plainly. But how many times have you seen traders argue with the tape instead of obeying it? The habit of entering with conviction but avoiding failure is rooted in ego. The trader wants to be right. He wants the market to confirm his intelligence. He treats the trade like a personal statement instead of a business transaction. But speculation is not a courtroom where you argue your case. It's a business where the market is always the senior partner. Have you ever noticed how the market never explains itself, yet always collects its due? When I studied price action, I learned that every valid trade has two prices: the price that gets you in and the price that tells you you're wrong. Without the second price, the first is meaningless. A chart pattern without a failure point is just a picture. It becomes a hope, not a plan. And hope is the most expensive thing a trader can own. Ask yourself this: are you trading what you see, or what you want to see? Many traders confuse confidence with stubbornness. They hold on because they entered with such certainty that admitting failure feels like betrayal of their own judgment. But the market doesn't care about your judgment. It only cares about supply and demand, and it changes its mind without apology. The best traders I ever knew were quick to admit error. They didn't linger. They didn't explain. They simply got out. How fast do you step aside when the market proves you wrong? There is a kind of false courage in refusing to define failure. It sounds brave. It feels bold. But it is really avoidance. The trader is avoiding the small pain of a controlled loss, and in doing so, he invites the large pain of a catastrophic one. I've seen fortunes made by men who were wrong often but wrong small, and I've seen fortunes lost by men who were right once but wrong too long. Which side do you think survives? Charts are honest teachers if you let them be. A stock that cannot rally on good news is telling you something. A market that breaks support and fails to recover is not asking for your opinion. It is issuing a warning. Defining failure is simply agreeing to listen. It is saying, if the market behaves this way, my idea is invalid. That is not weakness. That is professionalism. When you look at your charts, do you mark your exits as clearly as your entries? Wealth in trading is built not from bold predictions, but from consistent behavior. A trader who defines failure in advance is a trader who can stay in the game. Capital is ammunition, and every unnecessary loss is a bullet wasted. You don't need to win every trade. You need to protect your stake so you can take the next one. Isn't it odd how traders obsess over finding the perfect setup, but neglect the simple act of capital preservation? I learned to treat every trade as a hypothesis, not a belief. The market either confirms it or rejects it. When it rejects it, I move on. No drama, no argument. just business. That mindset frees you. It keeps you flexible, and flexibility is what allows a trader to grow alongside the market instead of being crushed by it. Have you ever noticed how the market rewards those who adapt faster than those who insist? The trader who enters without defining failure is trading with blinders on. He is focused only on upside, and that narrow focus distorts his judgment. He averages down when he should step aside. He adds when the market is warning him. He calls it patience, but it is really paralysis. The tape keeps printing, the chart keeps forming, and still he waits for the market to agree with him. How often have you waited for agreement instead of evidence? Every successful campaign I ever ran began with a clear understanding of risk. Not because I was pessimistic, but because I wanted to stay solvent. The market offers endless opportunity, but only to those who survive long enough to see it. Defining failure is not about expecting to lose. It's about being prepared to lose correctly. There is a right way to lose in this business, and most traders never learn it. Do you know the difference between a planned loss and a reckless one? As traders mature, they stop asking how much they can make and start asking how much they are willing to risk. That shift changes everything. It changes how you read charts. It changes how you size positions. It changes how you sleep at night. Confidence built on preparation is calm. Confidence built on hope is noisy and anxious. Which kind of confidence do you bring to your trades? The market is a hard teacher, but it is fair. It punishes denial and rewards clarity. When you define failure in advance, you remove emotion from the decision. You are no longer improvising under pressure. You are executing a plan. And execution is where consistency is born. Traders who lack this habit drift from trade to trade, always busy, never progressing, always wondering why results don't match effort. Have you ever felt busy in the market but strangely unproductive? I've watched traders celebrate entries like victories and treat exits like defeats. That backward thinking keeps them trapped. The entry is just the beginning of a conversation with the market. The exit is the conclusion, whether it ends in profit or loss. Both matter. Ignoring one is like reading only half the tape. When you place a trade, do you already know how the conversation ends if the market stops listening to you? Conviction without a defined failure point is not confidence. It is exposure. And exposure without control is speculation at its most dangerous. The market rewards preparation, not confidence. I learned that lesson the hard way, and I paid tuition for it more than once. Confidence feels powerful when you're entering a trade. It straightens your back. It quiets doubt. It convinces you that this time you see something others don't. But the market has never paid a man simply for feeling sure. It only pays those who are ready before the price moves against them. Let me ask you this. How often have you felt confident, only to realize later that confidence didn't protect you when the tape turned? Preparation is quiet work. It doesn't announce itself. It happens before the market opens and long before the order is placed. It lives in studying past movements, understanding how stocks behave when they are strong and how they fail when they are weak. Confidence, on the other hand, often shows up late. It appears after a few winning trades, after a clean breakout, after the crowd starts agreeing with you. But by then, the risk is already higher. Have you noticed how confidence usually arrives after the easy part is over? I've seen traders walk into the market armed with nothing but belief. They believe a stock must go higher. They believe the news justifies the price. They believe they are early, and belief gives them courage, but it does not give them protection. When the market challenges them, belief has no answers. Preparation does. Preparation already knows what to do when the price hesitates, when volume dries up, when support fails. Confidence asks the market to behave. Preparation assumes it might not. Which one do you think survives longer? A prepared trader knows his trade before he takes it. He knows where it is strong and where it is vulnerable. He knows how much he will risk and why that amount makes sense. He is not guessing. He is executing a plan built from observation, not emotion. Confidence alone skips that work. It says, I feel right, and mistakes that feeling for an edge. But feelings don't read charts. Feelings don't measure risk. Have you ever confused familiarity with preparedness? The market has a way of humbling confident men quickly. A sudden reversal, a false breakout, a slow grind against your position that drains your patience before it drains your capital. When that happens, confidence turns into defensiveness. The trader starts explaining instead of listening. He justifies instead of adjusting. Preparation doesn't argue. It responds. It recognizes the change in character and acts without hesitation. How quickly do you shift from explanation to execution when the market stops doing what you expected? Confidence often makes traders bold at the wrong moment. They size too large because they feel sure. They add because they don't want to be wrong. They delay exits because they trust their opinion more than the evidence in front of them. Preparation keeps position size reasonable. It respects uncertainty. It understands that no setup, no matter how clean, is guaranteed. The prepared trader doesn't need to feel brave. He needs to be consistent. Isn't consistency more valuable than courage in the long run? When I studied the great moves, I noticed something important. The men who stayed with trends weren't the most confident. They were the most prepared. They understood normal reactions. They expected pullbacks. They didn't panic at noise, but they didn't ignore danger either. Their preparation allowed them to sit tight when sitting was correct and step aside when it wasn't. Confidence without preparation would have shaken them out too early or trapped them too long. Which mistake do you see more often in your own trading? Preparation also shapes mindset. A prepared trader accepts losses as part of the business. He doesn't personalize them. He doesn't see them as proof of failure. They are simply outcomes of a plan executed properly. Confidence-based traders take losses personally because their identity was tied to being right. That emotional attachment clouds judgment on the next trade. Preparation keeps emotions contained because the trader already accepted risk before entering. Have you ever noticed how calm traders seem when they lose the right way? The market is not impressed by bold opinions. It responds only to supply and demand. Preparation aligns you with that reality. It forces you to ask practical questions. Is this stock under accumulation or distribution? Is the volume confirming the move? Is the broader market supportive or hostile? Confidence skips these questions because it already has an answer. But answers without questions are dangerous in speculation. Do you question your trades before the market does it for you? Wealth in trading is built slowly through repeated correct behavior. Preparation supports that process. It creates rules, boundaries, and habits. Confidence alone creates spikes, big wins followed by bigger setbacks. The equity curve of a confident but unprepared trader is wild and exhausting. The prepared trader's curve is steadier, even if it looks boring, and boring is often profitable in this business. Would you rather feel excited today or solvent next year? Preparation also guards against overtrading. When you know exactly what you're waiting for, you don't chase everything that moves. Confidence tends to see opportunity everywhere. Preparation sees opportunity only where conditions align. That selectivity preserves capital and focus. It keeps you from forcing trades just to stay active. The market doesn't pay for activity. It pays for timing. How often do you trade because you're prepared, and how often because you're restless? I've always believed that the market teaches the same lesson repeatedly until it's learned. Traders who rely on confidence keep learning it the hard way. They win just enough to reinforce bad habits and lose just enough to stay confused. Prepared traders may lose too, but they lose with understanding. They review. They adjust. They refine. Confidence resists review because it assumes correctness. Preparation invites review because it seeks improvement. Which approach leads to growth? There is a quiet confidence that comes from preparation, but it's different from bravado. It's calm. It doesn't rush. It doesn't need validation. It allows the trader to wait for confirmation and act without hesitation when it appears. That kind of confidence is earned, not assumed. Undefined risk turns opinions into liabilities. That is one of the hardest truths for traders to accept, because opinions feel solid. They feel earned. A trader studies a chart, reads the tape, watches the market day after day, and naturally forms a view. He believes a stock is strong. He believes a market is weak, and belief feels like work has been done. But the market does not reward opinions. It charges rent for them. Let me ask you something. How many times have you paid for an opinion that had no defined cost? An opinion without a defined risk is not analysis. It is exposure. The moment you put money behind a view without deciding how much you are willing to lose, that view stops being harmless. It becomes a liability. It sits on your account like an unpaid bill, growing with time and volatility. Traders often think the danger lies in being wrong, but being wrong is manageable. Being undefined is not. Have you ever noticed how small mistakes become large ones only when no boundary was set? I have held strong opinions in my life, and I have watched them dissolve under the weight of the tape. The market has a way of testing conviction by pushing just far enough to see if you will flinch. When risk is defined, that test is simple. You either stay or you step aside. When risk is undefined, the test becomes psychological. You hesitate. You rationalize. You remember why you liked the trade instead of observing what it is doing now. That is when an opinion quietly turns into a threat. How often do you defend your view instead of measuring it? Charts do not care about your reasoning. They record behavior. Price moves where demand outweighs supply, and it falls where the opposite is true. An opinion tries to explain why this should happen. Risk management prepares for what happens if it doesn't. The trader who ignores risk believes explanation will save him. It won't. The market doesn't reverse because you make a good argument. It reverses when conditions change. Do you prepare for change, or do you assume consistency? Undefined risk invites traders to average down, not because it's logical, but because it feels like action. The trader tells himself he's improving his position, when in truth he's increasing his liability. His opinion grows larger as the evidence against it grows stronger. This is not strategy. It is attachment. An attachment in trading is expensive. A prepared trader limits damage quickly. An opinionated trader expands it slowly. Which one do you think sleeps better? The danger of opinion-based trading is that it shifts focus away from price. The trader starts watching news, listening to commentary, searching for confirmation. Anything that supports the opinion feels comforting. Anything that contradicts it feels suspicious. The chart becomes secondary. Risk becomes invisible. This is how traders lose objectivity. They are no longer trading the market. They are trading their need to be right. Have you ever noticed how the louder the opinion, the quieter the discipline? Every trade must answer one simple question before it is placed: where am I wrong? If that question has no answer, the trade has no structure. It floats, and floating trades drift into trouble. Risk defined in advance anchors the trade. It limits the damage and preserves capital for better opportunities. Without that anchor, even a correct opinion can lead to loss, because the trader doesn't know how to manage success either. Do you manage your trades, or do they manage you? I learned that the market is full of intelligent men with strong views and empty accounts. Intelligence sharpens opinions, but discipline protects capital. Undefined risk allows intelligence to work against you. It gives clever traders more ways to justify staying in bad positions. Simpler traders with clearer rules often fare better because they do not negotiate with the market. They listen. They act. They move on. Isn't it ironic how complexity often increases vulnerability? An opinion feels private. Risk is public. The market sees your risk even if you don't. It tests it. It presses against weak points. When traders complain that the market is unfair, they are often reacting to risks they never acknowledged. The market didn't ambush them. It exposed them. Risk ignored does not disappear. It accumulates, and accumulated risk eventually demands payment. Are you tracking your exposure, or hoping it stays quiet? Wealth building in trading depends on survival first. You cannot compound opinions. You can compound capital. Undefined risk threatens that foundation. It creates drawdowns that take time and emotional energy to recover from. It forces traders to trade defensively when they should be selective. Defined risk keeps losses small and confidence stable. It allows opinions to be tested without endangering the account. Isn't testing ideas safer than betting identities? The best traders I knew held opinions lightly. They were not married to them. They were willing to change their minds because their risk was already controlled. That freedom, comes only when loss is acceptable and planned. Traders who fear loss avoid defining it, and in doing so, they guarantee something worse. Fear does not disappear when ignored. It grows, it clouds judgment, it delays action. How often does fear disguise itself as patience in your trading? An undefined risk position demands constant attention. It drains focus. It distracts from new opportunities. Defined risk positions can be left alone. They either work or they don't. That simplicity is powerful. It frees mental capital. It keeps trading mechanical instead of emotional. Opinions love complexity. Risk management thrives on clarity. Which one governs your decision-making process? The market does not require you to abandon opinions. It requires you to price them correctly. Every opinion must come with a cost of being wrong. That cost must be acceptable before the trade is entered, not negotiated afterward. Traders who learn this stop fearing losses. Traders who ignore it fear everything. The difference is not confidence. It is preparation and respect for risk. Ego delays exits longer than charts ever should. I've watched this truth play out more times than I can count, and every time it looks the same. The chart gives a warning, then another, then a clear signal that something has changed. And still the trader stays. Not because the setup is intact, not because the tape supports it, but because leaving now would mean admitting that the original decision was wrong. Let me ask you, how often have you stayed in a trade simply because you didn't want to admit defeat? Ego is subtle in trading. It doesn't always shout. Sometimes it whispers. It tells the trader to give it a little more room. It says the market is just shaking out weak hands. It reminds him of past trades that came back after looking hopeless. Ego is patient in the wrong way. It stretches time and distorts judgment. Charts, on the other hand, are blunt. They say what they say and move on. When price breaks support, it doesn't apologize. Why do traders expect it to? A trader with ego tied to his positions treats exits as judgments of his intelligence. A stopped-out trade feels like a personal failure rather than a business expense. That mindset makes exits painful, and pain delays action. The trader waits for certainty, but certainty never comes at turning points. By the time he feels sure, the loss has already grown. Charts don't wait for comfort. They mark failure early. Do you act on early signals, or do you wait until the damage is undeniable? I learned that the hardest skill in trading is not knowing when to enter, but knowing when to leave. Entries are exciting. They carry possibility. Exits feel final. They close the door on hope. Ego clings to that hope, even when the chart has withdrawn its invitation. The trader starts managing his emotions instead of his risk. He watches every tick, searching for reassurance. Meanwhile, the market continues to do what it does best, move without regard for personal attachment. Have you noticed how the market never hesitates the way traders do? Charts are efficient communicators. They show strength through higher highs and higher lows. They show weakness through failed rallies and expanding volume on declines. When those signals appear, the trade's character has changed. The ego-driven trader refuses to update his assessment. He trades memory instead of reality. He remembers why he bought, not why he should leave. That memory becomes an anchor, and anchors are heavy in fast-moving markets. How often do you trade what was instead of what is? Ego also distorts time. A trader tells himself he's a long-term holder now, even though he entered for a short-term move. He redefines the trade to avoid admitting error. The chart does not adjust to these redefinitions. It continues to reflect supply and demand, not personal narratives. This shift in time frame is one of the quiet ways ego keeps traders stuck. Have you ever changed your time horizon after the trade started going against you? The longer ego delays an exit, the more emotional the decision becomes. What could have been a small, planned loss turns into a stressful dilemma. The trader starts checking news, seeking opinions, asking for reassurance. He becomes reactive. By the time he exits, he does so in frustration or fear, not clarity. That emotional exit often happens near the worst price. Charts gave the signal earlier, but ego muted the message. How much money has ego cost you by making simple decisions complicated? Professional traders learn to separate self-worth from trade outcomes. Ego resists that separation. It wants credit for wins and excuses for losses. Charts offer neither. They only offer information. Traders who respect charts more than ego act quickly and calmly. Traders who respect ego more than charts hesitate and justify. One group survives drawdowns, the other explains them. Which group do you see yourself in most days? I've known traders who could read charts brilliantly, but still lost money because they couldn't exit cleanly. Their analysis was sound, their timing was decent, but their ego demanded validation. They wanted the market to acknowledge them. The market doesn't acknowledge anyone. It moves. That indifference is what makes it dangerous to those who seek approval from price. Do you want the market to reward you or to agree with you? Ego also shows up after wins. A trader who has been right several times begins to trust his judgment more than his rules. He starts giving trades more room. He assumes he can sense when something is wrong. That confidence feels earned, but it is fragile. When the market shifts, ego slows the exit because the trader believes his track record should count for something. The chart doesn't keep score. It resets every day. Have you noticed how quickly past success loses relevance? Exit discipline is the true measure of a trader's maturity. Anyone can place a stop. Not everyone can honor it. Ego finds reasons to move it, widen it, ignore it. Each adjustment feels small. The damage accumulates quietly. The trader remains busy, involved, hopeful. Meanwhile, the account absorbs the cost. Charts offered an exit, ego declined it. That choice rarely improves with time. The market tests ego by moving just far enough to provoke doubt, then just far enough to provoke fear. Traders who act early preserve capital and confidence. Traders who wait for emotional certainty lose both. The chart never asks you to be brave. It asks you to be observant. Ego confuses bravery with stubbornness. How often do you mistake endurance for skill? Exiting a losing trade is not quitting. It is completing the trade. The outcome does not define you. Your response to information does. Charts provide that information in real time. Ego prefers the story you tell yourself. When those two conflict, one must yield. Successful traders know which one to sacrifice. Unsuccessful traders protect ego and pay with capital. The chart is always current. Ego lives in the past. It remembers effort, analysis, intention. The market prices none of those things. It prices action. When you delay an exit, you are choosing memory over evidence. That choice compounds risk. It limits flexibility. It narrows future opportunity. Every trade is a hypothesis, not a belief system. That idea saved me more money than any indicator ever did. A belief demands loyalty. A hypothesis demands testing. The market responds only to the second. When a trader treats a trade like a belief, he defends it. When he treats it like a hypothesis, he observes it. Let me ask you, do you enter trades to prove something, or to see if something works? A hypothesis begins with uncertainty. It accepts that the market may or may not behave as expected. That acceptance shapes behavior. The trader plans for confirmation and invalidation. He watches price action for evidence, not reassurance. A belief begins with certainty. It assumes correctness and waits for agreement. That difference determines how a trader reacts under pressure. Have you noticed how belief makes traders emotional, while hypotheses keep them curious? Charts are testing grounds. They don't reward conviction. They reward alignment. A trader forms an idea based on structure, trend, and volume. That idea is not sacred. It is provisional. The moment price stops behaving in a way that supports it, the hypothesis is weakened. When key levels fail, the test is complete. A belief resists that conclusion. It argues that the test was unfair, incomplete, or mistimed. Which reaction sounds more professional? The danger of belief-based trading is that it personalizes outcomes. A winning trade validates the trader. A losing trade threatens identity. That emotional weight distorts decision-making. The trader begins to manage feelings instead of risk. Hypothesis-based trading removes identity from the equation. Wins and losses are data points. They inform future decisions. They don't define the trader. Do you review your trades as evidence or as verdicts? I've seen traders turn simple setups into complicated commitments because they believed in them too strongly. They added indicators, searched for supporting opinions, and reinterpreted price action to fit their narrative. All the while, the chart was quietly disproving the original idea. Hypotheses don't need reinforcement. They need observation. When the evidence changes, the hypothesis changes or is discarded. How quickly do you discard ideas that no longer fit the facts? A hypothesis has a built-in exit. It states clearly, if price does this, the idea is wrong. That clarity makes execution easier. Beliefs avoid that clarity. They prefer flexibility, which is really indecision. A trader who believes tends to widen stops, adjust targets, and delay exits. He calls it patience. In reality, he is negotiating with reality. Hypotheses don't negotiate. They conclude. Which approach do you think reduces stress? The market constantly runs experiments on traders. It tests discipline, patience, and adaptability. Those who operate with hypotheses can absorb these tests. Those who operate with beliefs take them personally. When a hypothesis fails, the trader learns something about market behavior. When a belief fails, the trader feels attacked. That emotional response often leads to revenge trading or paralysis. Have you ever noticed how quickly frustration follows a threatened belief? Wealth building in trading depends on repeatable processes. Hypotheses support that. They can be replicated, measured, refined. Beliefs resist standardization.